Manoj was checking the stock prices. He was so excited to find the prices of his invested shares going up. All of you have heard about the share market and stocks. What are these stocks or equities? Hello dear learners, I am Avanti. Let us understand more about stocks or equities through this quick learning session. Companies sell stocks to raise funds to grow their business. When they sell the equities or stock, they are inviting investors to purchase a fractional ownership in the company. One can buy and sell the stocks in the capital markets. Stocks, also called equities, are units of ownership in a company entitling investors to certain benefits. When you buy 1,000 shares of a company with 10,000 shares, you have the equity of 10% in that company. When you invest in stocks, you are entitled to certain benefits like voting rights. Investor may have the right to vote at the company's annual shareholder meetings. Dividends. Investor may receive a share of the company's profits. Capital appreciation. When the company's stock price goes up, the shares increase in value, and when the price of a stock declines, the value of shares fall. When the companies decide to sell their shares to the public for the first time, they need to release initial public offering (IPO) in the primary capital market. The company and its advisors disclose how many shares of stock will be issued and set an IPO price. The funds raised will be going to the company directly. After the IPO offering is complete, the shares can be traded in the secondary capital markets. So now, let us discuss the types of stock. Stocks are mainly of two types: common stock. Common stock generally entitles investors the right to vote at shareholders' meetings and to dividends paid out by the corporation. Preferred stock. Preferred stock typically does not give any voting rights, although preferred stock generally entitles holders to receive dividend payments before common stockholders. In addition, preferred stockholders have higher claims on assets and earnings of the company. Classes of stocks. There are different classes of stocks offered by the companies, and they designate them with letter A, B, or C. Class A stock gets one vote for each share. Class B stock is held by the company's founders and gets more votes per share. They are not publicly traded and exist to help the founders retain control over the company. Class C stock has no voting rights and is largely held by employees and some common shareholders. Dividends. Companies may share their profits with you via dividends. Investors receive dividend payments quarterly or annually, with payments allocated based on how many shares of the company's stock you own. Different companies have different dividend plans. Dividend Reinvestment Plan (DRIP). These plans allow you to reinvest the cash dividend payments back into the stock and expand your investment holdings. Stock dividends. If a company declares a stock dividend of 5% and the investor holds 100 shares of that company, one would receive 5 additional shares of stock, bringing the holdings to 105 shares. Hybrid dividends. They are a combination of cash and stock. Stocks give the investors an opportunity to be part of the world's successful companies. Investors can use these as the tool to grow their money and plan for long-term investment to meet the financial goals like retirement or child's education. You can easily diversify your investment portfolio by investing in different companies in different industries. This helps the investor enjoy gains in thriving sectors while offsetting losses in others. To know more about the capital markets and stocks, keep watching Infosys Springboard. Happy learning!